Okay, we got a 2% order on a $500 account. Our spread is 12.6 and we see a little bit of a green candle. So let's hit sell and we can see here we've entered at just over 2,000 units and we are currently down $2. Now, if the spread was much lower, we would have entered here and only been down maybe 30 cents, 40 cents. So if we have a large spread and we are close to our stop loss, we may be 10 pips from our stop loss, but due to the spread, it would stop us out early. Conversely, with our take profit, if this is the distance here of 12.6 pips, we would need to go beyond our take profit limit by 12.6 pips before we would actually hit our targets. The spread is displayed up here, and the difference between these two prices, we have 1.251 versus 1.25226. Okay, moving into an actual example of this. Here is a practice trade that I am in. It's a 35 bounce on the Australian dollar, New Zealand dollar, and it's at a 1.25 to 1. We can see with our trade setup, it looks like we just hit targets perfectly on the dot with that big spike up there. However, our trade is still active because due to our spread, we didn't get far enough above that peak on the take profit in order for our take profit to be triggered. Within 1 pip by the looks, our spread is 1 pip, so our take profit is set to 62.1 pips. Now that peak, it looks like it went to 62.3, just 0.2 pips above our take profit level, but due to the spread being around 1 pip right now, that means we didn't hit high enough to trigger our take profit. Now visually, it looks like that was a profitable trade, however, it has not closed yet. So this is why I've included spread in the backtesting template, so you can account for instances like this. And if we drop down to the 15-minute chart, we can see here it once again looks like a winning trade. The graphics in TradingView have shown it to be a winning trade, but the trade still being active proves that that didn't happen. So that's how our spread plays in when we're dealing with backtesting as well as live trading.